So I want to look at how to adjust your portfolio when a company announces a stock split. How do you adjust your portfolio whenever a company announces a stock split? So in this case, you consider number one, understand the stock split details. You understand the details behind the stock split. In this case, you check the ratio. Check the ratio. Identify whether it is a 2-for-1 or a 3-for-1 or other type of splits. So this determines how your share counts and the per share price will change. These ratios will determine how the share price of the company will change. And then you consider effective dates. So know the date when the stock split will take effect to plan any adjustments. When will then the the effective date commence? So in that case, you plan how to adjust your portfolio accordingly. Number two, evaluate the company's fundamentals. You need to evaluate critically the companies and fundamental. You look into the company's growth potential. So in this case, review the company's performance, growth trajectory, and market position to ensure it remains, a strong investment after a split. That is the post-split. And not only that, you equally take into consideration market sentiments. So assess whether the split is likely to boost investors' interest or is being used as a tactics to mask, critical, negative, underlying issues. You need to ask yourself that question. Number three, consider your portfolio goals. You consider your portfolio goals or aims or targets. So in this case, you may take into consideration your long-term goals. If the company aligns with your long-term objectives, such as growth or dividends, you might need to you may not need to make any changes because you feel it aligns with your long-term investment objectives. So equally, look at rebalancing needs. So if the stock split, significantly alters the weight of the stock in your portfolio, consider rebalancing your portfolio to maintain your, optimal diversification level. So we need to really, look into how it affects your portfolio, and if and when necessary, you carry out, rebalancing to be able to attain optimal, portfolio, optimal limit of the constituent stocks of your in your portfolio. And number four is monitor post-split performance. You monitor, post-split performance. After the company undertakes, a stock split, you need to monitor, the thereafter. What happens after, the stock split? So in that case, you will then need to consider trading volume. Increase in liquidity can affect price movements. Monitor how the stock performs immediately after the split. Not only that, you may equally need to take into consideration market reaction. So evaluate whether the market is reacting positively, negatively, or if the market is neutral or it remains indifferent to the split. These aspects are very, very important. Please like this video and subscribe to this channel. Number five is adjust your holding if necessary. You adjust your holding. You carry out a kind of portfolio rebalancing. So in this case, you may decide to add to your position. You may decide to increase your position. So if the stock split improves liquidity and you believe in the company's growth prospects, you may consider buying additional shares. If you believe the company will then grow, at an above average clip, so you can decide to add to your positions. You may equally trim your position. You may decide to reduce your position. So if the stock becomes overvalued due to heightened investor excitement, you might, consider selling, some shares. If the action attracts investor and the bid of the price to a level of overvaluation, it's advisable you sell, some shares and then you take profit. Number 6, before then you may equally need to just, hold your position, So if you are a long-term investor and you still believe in the company's fundamental, you may stay invested and and then you don't sell your position. You may not even buy more. You simply hold a position and remain invested in the company. Number 6, evaluate the tax implication. Evaluate tax implication that's associated with the stock split. So in this case, there may be no immediate tax impacts. So stock split don't trigger taxable events, but adjust to your cost basis, per share, or you may need to make certain readjustments so as to be able to to avoid future tax calculation. You need to carry out adjustments to avoid tax in the future. Number 7 is avoid overreaction. So in this case, you focus on the fundamentals, focus on the company's fundamentals. Remember, a stock split doesn't change the intrinsic value of the company. It doesn't really change the company fundamentally. What really changes the company is the company's financials, the company's fundamentals, and not the stock split. And so avoid making rash decisions based solely on the split announcement. Don't just act because of the split announcement. No. Look at the fundamentals critically, and look away, ignore the split announcement. Number 8, consult your financial, plan. I'm very sure you must have had the plan in mind before you invest. So fall back to your financial plan, make consultation and then know what next to do. So in this case, you align with your strategy. There should be an alignment with your strategy. So ensure your action taking, ensure that any action you take, are kind of consistent with your overall investment strategy as well as your financial goals and objectives. So by carefully evaluating the implications of the stock splits and your portfolio alignment with your goal, you can make informed decisions that maximize your investment outcome. So don't be so much bothered about the stock splits. Look at what the fundamental is saying, and then you make necessary adjustments where and whenever necessary.